Hello guys, and welcome back to Trade to Learn. Today's video is going to be all about bear versus bull markets. So let's get right into it. The first thing we're going to talk about are bear markets. A bear market is a period of months or even years where stock prices decline. Bear markets have a very pessimistic market, and one example is the Great Depression. The stock market crash of 1929 kicked off the start of the most famous bear market. It didn't end for years after, and during that time, many Americans lost their jobs, homes, and well-being. It wasn't just America either. The entire world felt the impacts of America's bear market. Another example are the years following the dot-com bubble bursting, seeing a massive dip in the stock market. Many tech companies went bankrupt as well. Household wealth took a hit of over $6 trillion, leading to a recession. These are the 5 indications of a bear market. Number 1, a high rate of unemployment. Number 2, a very slow economy. Number 3, companies losing profits. Number 4, a large fall in stock prices. And finally, number 5, drastic changes in government tax. There are 4 main phases of a bear market. The first one is characterized by high prices, and towards the end of this phase, investors begin to drop out of the market and take in profits. Number 2, in the second phase, stock prices begin to fall sharply. Trading activity and corporate profits begin to drop, and economic indicators that once may have been high start to become below average. Some investors begin to panic and buy and sell at the wrong times. Number 3, the third phase shows speculators starting to enter the market, consequently raising some stock prices. A speculator utilizes strategies in typically a shorter time frame in an attempt to outperform traditional long-term investors. Speculators take on risk, especially with respect to anticipating future price movements, in hope of making gains that are large enough to offset the risk. In the fourth and last phase, stock prices continue to drop, but slower, as low prices and good news attract investors again. Bear markets turn into bull markets. Now, we're going to talk about bull markets. A bull market is the opposite of a bear market. Stock prices increase due to healthy economic situations. A long bull market occurred from the early 1980s up until the dot-com bubble bursting in the early 2000s. During this bull market, there was an average market gain of nearly 600%. Another example of a bull market is the past 6 months. Once Moderna and Johnson & Johnson got FDA-approved vaccines, businesses have opened and jobs are growing again. These are 3 indicators of a bull market. Number 1, the GDP in a country rises. GDP stands for Gross Domestic Product. This is the momentary value of all goods and services of a country. Number 2, rise in stock prices. And lastly, increase in jobs. There are also 4 phases in a bull market. The first one is the pessimism phase. This phase usually begins after a long downtrend. During this time, the market seems to be at its worst and the news flow is still bad. But the market stops reacting to the bad news. However, smart investors enter the market during this phase. It's very hard to tell if you must enter the market because every source will tell you not to. The next phase is the skepticism phase. During this phase, the news stops being negative, but most investors are still not convinced. This is because the market is very volatile. Investors start looking at base measures such as PE ratios and only buy stocks if they are a very good buy. The price to earnings ratio, PE ratio, relates to a company's share price to its earning price. A high PE ratio can mean that the company is overvalued, or else the investors are expecting high growth rates in the future. You might hear experts and the press saying that the market is climbing the wall of worry. The third phase is the optimism phase. During this phase, the news flow starts becoming more and more positive and negative statements reduce. This phase is usually very long and many investors start buying. Volatility reduces and small dips become profitable. The next and final phase is the euphoria phase. During this phase, making money becomes a lot easier. The perception is that the market will continue to grow. The investors who were once on the sidelines until now finally start buying. That was all for today's video. We learned about the differences between bear and bull markets, some indicators, and the 4 phases. Hope you enjoyed. See you next time.